Hello everyone. Um, Anyways, it's late tonight, so I'm gonna try to do a quick video on some advanced strategies, and hopefully we can get this video out for you. And hopefully I can help you guys in some way or another. Okay, so as you know, I have to have a disclaimer. This is just for educational purposes. It's not meant as an investment advice. Okay, so let's get this thing started. I mentioned to you guys I play a lot of SPX, right? And we all know that SPX has 3 expiration every single week, right? As you can see, today is, I rewinded, so today's June 14th. Sorry, we're on demand. So as you can see here, June 14, June 16, June 18, right? And now the good news is when it's your monthly expiration, you have one extra right there, one extra expiration, which is AM expiration. So basically on Thursday night is another expiration. So you got Monday, Wednesday, then you can play Thursday for the AM expiration and the Friday AM expiration, PM expiration. So as you can see here, Friday, Monday, Wednesday, Thursday, because it's AM, that means that the settlement at the open is the price. Well, that's what it is. Now it's trust me, you just want to close out. If you're going to do an AM expiration, you just want to close out and get it over with. You don't want to know what happened overnight and things like that. So, but again, SPX has plenty for you to play every single week. Okay, so with that said, let's start off with advanced strategy. I'm gonna get into it really quick here. I'm sure you guys all aware what a vertical spread is, okay? So basically it is either a credit spread or a debit spread, right? So credit spread meaning you sell one and you buy the further out. Same thing on the call side. You sell one and buy one further out, right? The reverse is true if you do a debit. You buy one and sell the other. Buy one, sell the other. So debit, you buy first. Credit, you sell first. Okay? So very simple. Not going to spend a lot of time because this is advanced. Now, with that said, let's just figure out something here. Okay? Tesla. Let's kind of give you guys an example here. Okay, if I had a credit spread, okay, and I sell a 620 and I buy a 630, I am $10 wide. Okay, this and this is $10 wide. My credit on this 620 is $10.40. That's the mid price. The 630 is $6.55, right? So how do we figure that out, right? So basically, you getting credit of $10.40, and you paid $6.55. So your total that you credit was only $3.85, right? Right. So since we have a $10 credit, you're gonna lose, max loss is $6.15. Okay. So $6.15 is max loss. $3.80 is max profit. Okay. So I'm hoping that you guys understand all this right now, okay? Because there is, I'm not gonna get into too much now. at 620, Tesla is a credit, so you're expecting Tesla to go down in price, right? Or at least stay below 620 just by 1 penny. However, Tesla decides to start creeping up on news. What can you do, right? You can turn this in two ways. One, hold on here. You need to look at your delta, between these two. Okay. So your delta of 620 is 45, and your 630 is 33, right? So you got a 12 delta, right? So you have a 12 delta, and say you have you only buy one set or one spread. Okay, that means all you need to do is, if Tesla were to pop, you just need to buy 12 shares. Because what did we say before? What is delta? For every dollar Tesla moves, it moves a certain amount of money, right? And here, your max loss, what did we say? $6.15. 620 to 630, that's $10. If you have 12 shares and it goes up $10, right? That's 120 bucks. You guys following me? So you basically cap back your money. You just made back your money just by scalping Tesla to the upside, right? Very simple. Now, how can you turn it also if you don't want to buy shares? You can see here 620 on the put side and 610. Okay, $10 Y. We're doing the $10 Y. You don't have to do $10 Y, but you know it keep it on in this way. Now, Tesla's starting to creep up. Of course, remember, stocks goes like this, right? Up, 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 down, 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 up, 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 down. So you're thinking, okay, I'm gonna lose $615. Now, how am I gonna recuperate? You can, one, sell the other side, turn it into an iron fly. Okay, so you sell 620 and you buy 610. Okay, so vertical, you do 620 and you buy 610. Okay, so your debit here, what did I do? Oh, sorry. Yeah, I sell one. Why am I 620? Why is it a debit? Sell 620. Check. Oh, call. Sorry. There we go. So look, you get $4.77 as a credit. Of course, this price is going to change as the stock move up or down. But hopefully you guys going to get my drift in this regard. Okay. You already getting a credit on this side. Now you just get a credit on this side to basically flatten out your position. So instead of you losing 615, you get a credit of 477. Now, how are you going to lose this? Remember, so my max loss is 533. But that means that Tesla has to be below, because this is a credit put, Tesla got to be below 620. But if it's below 620, you're going to make money on this side, on the call side, right? So you're going to make that credit of 4 something, you're going to lose. So you're basically trying to flatten your position. Okay, I hope you guys understand where I'm going. Okay, so you can do both of this at the same time. One is scalp 12 shares or even 20 of Tesla stock. Make a little bit of money, right? You also open a credit spread on the other side to make it into an iron fly. Okay? Now, you just basically get yourself flat. Flat. Now that's my biggest word when you're playing option, is you want to be flat. Okay? Why flat? Because when you're on the losing end, you just want to be flat. Now, here's the deal: is say you do one contract. Let's just give you an idea. You do one contract with the 620 and the 630 call. Okay, Tesla start creeping up here to 650. What are you gonna do? You do 620 and 610 debit put, but instead, you don't know what this is because it's already here already as you're trying to open this side and say this side is a credit to only $2. Well, guess what, guys? You just do two contracts or two position, right? You understand what I'm saying here? So you open more, you're gonna get max loss and max gain, but because it's already popping up, yeah, your max loss is gonna be further, but then you got this to cushion. And remember, if it go down again, guess what you do? Unfortunately, Tesla is one of those stocks that you cannot short. It's very hard, but I'm just doing Tesla today. You can, there's other stock that you can short, so you can short it again, right? Short 20 shares for it to go down, make some extra money, scalp it so it can go down. Okay, so that's one strategy. You can turn it into a butterfly, right? So 620 and 630, right? Now you just need to, you got a credit here. You're doing a credit spread of 620 and a 630, receiving $4 and what was it, 85 cents? I don't remember. Now you just open the other side and do a debit spread, or so you sell a 620 and buy a 610 call, and now it becomes a butterfly. Remember what a butterfly is? Here's my butterfly, right? Here's the body and the wing. But since your wing is 630 on this side, and your body is already 620, right? So now you have to an even width, so this has to be 610, and you have to sell one more to make the body. So you got 1, 2, 1 as a butterfly. Now this is not the greatest strategy when you're losing because of the fact that it has to come back to 620 for you to make money. Other than that, you lose both sides. Okay, so I like the credit. I like the credit on the other side as an iron fly, multiplied by 1 or 2 extra, depending on what day, what expiration you have, and then start scalping the stock, right? Okay, so that's one way, right? So now let's talk about, now we're on iron fly, as you can say, we can do an iron condor. What's an iron condor? Iron condor, basically, you expecting Tesla to do this, and which it has, right? You sell a 600, you buy a 590, that's $10 Y. Let's say you receive $3 credit, right? So your max loss is 7. So you have to, on this side, you do 650, right? Let me do this. So on this side, you say you sell a 650 and a 660, receiving another $2. So basically, you're saying Tesla needs to be 650 and 600, right? This is where it needs to be. Tesla can range all day. It can go up a little bit, but then they drop back into range, or it can go down a little bit and then come back into range. And by the expiration, you make both ends, right? That's an iron condor. You do one side and you do the other side. Okay, very simple. Iron condor. Now, I don't recommend anybody to leg out of anything. Okay, but say for instance, iron condor, and Tesla starts to, you can literally make a little bit more money on Friday or Saturday, Friday, Thursday or Friday, if you speculate and know exactly where it's going. Okay, so if you have a 650 on the call side and a 660 on the call side, and Tesla's about to creep up further and further, guess what, guys? I have my put of 600 and my other put of 490, right? I can take this out so that I don't lose the rest of this and keep on the rest of this credit. Now, legging out is hard, but I always recommend to do it on the put side. And why I say that is because now you have a $600 sell put side, right? Tesla has to go back below 600 for you to lose money, right? But you took this out, meaning you stopped the loss on this, but you still got a few more credit on that. So now you turn it into what we call a Jade Lizzard, which is one short put, one short call, and one long call for protection. Okay, that's a Jade Lizzard. Now that's also a good strategy as well to leg out. I don't recommend you legging out on the call side, but here, 650, 660, Tesla starts to move up towards your 660. What do? You can close the short side and let this side run, right? But do I recommend it? No, because remember, stock does not go all in one way, right? Tesla can pop to 670, you close out 650, but you got greedy and you said, okay, I'm gonna let it run for a little bit, and then Tesla does this, and it goes back to 620. You just closed the 650 short, taking a loss, thinking the 660 is gonna keep on going, right? And you did not take profit on that, which you would have made good money, but instead you held it and it goes back down. Guess what? You just lost on this and you're gonna lose on this, right? Or if Tesla keep on ranging and you don't close out, theta burn, killed, right? So you got to understand how to do. Now, when I said leg out, if it's not the put side, I always leg out. If you're gonna leg out on the call side, always leg out on the short side. The put is to your discretionary, right? But the call, yes, you never want to leave a call because it can shoot to the moon. Okay, so that is another way. Now, let's talk about strangles and straddles. It's very simple. You can do long strangles or long straddles, and long straddles great for earnings. Okay, so think about this. You say, okay, Tesla has earning today. I'm going to do 620 on both sides. Okay, so 620 on both sides. My max loss on this, on the put side, is 1450, or right around, right? 1465. My max loss on the call side is 1045. So what happened now, right? So say there's risk to this strategy, but let's say this. Say Tesla earning and it pops all the way to 750. Guess what? Your max loss on your put is 1400. But guess what happened is your call side, delta expand, gamma expand, and guess what? This becomes maybe $30. So you just lost this. Well, you not literally lost because I'm sure you're not gonna hold it all the way to this get to zero, right? You're gonna exit out, first hour. I would not do anything the first 15 minutes after earning or 20 minutes after earning. Guess what? Because stock can fake you out, right? It pops, and you're like, okay, let me close this out, and all of a sudden, you got this. You just close this out to take a small loss, thinking that this is gonna pop to 30, and after 30 minutes, it does this. You just lose on this one too. Okay, so again, always wait for 30 minutes at least to know exactly what the stock does. Okay, remember IV crush. Okay, that is very likely that you're gonna get it after earnings. That IV crush is heavy. Okay, so you're basically your premium gonna drop big time. So it's always close out quick. This is a great strategy, not to hold, but to close on the profit. But you got to know, remember, wait that first 30 minutes. You know, you will get played. You close one end, you lose the other. Now, IV Crush, what happened to IV Crush? At you bought it at 620, and guess what Tesla did? It do nothing. It popped $2, 622. You did not make money on the 620 or the 620 put or call, because IV Crush, now you lost probably half of this and half of this. Okay, so playing this strategy is very scary, but you can make really good money when it pops. Look at Snap and things like that. So you need a big pop. If a stock just flat, you're not gonna make anything. You're screwed. Okay. Now a short strangle or short straddle basically is the reverse, right? So you, as we just talked about, if Tesla at 622 with IV Crush, you make that money instead of losing that money. So this is also a good strategy. You think that it's gonna stay the same. You sell 620 and you sell 620 on call and put. Now the bad thing is when you sell option, right? If Tesla move up, right? That means that this decays, say, to 0. But unfortunately, your max profit on this is 1400, right? 1450, whatever. But you just got your other side, your call side. It pops so hard that this gonna balloon up, and you're short. So it's just say, remember we say about if it popped to 30, guess what you lost, right? Or even higher, because it can keep going. So that's why I said the Jade Lizzard earlier. You just sell at 620 on both ends, and you maybe buy a 650. It's a little wider, just for protection. If it doesn't go, you know. So you still get this balloon up. This will move up pretty nicely. But again, IV Crush is hard. You know, especially earning plays. It's not the best way to do it. Okay, now another good way to do it, and I do this often, if you think a stock range in a certain range, okay, you got to remember here, guys, when I mentioned to you guys, this is on demand, so they don't have it, but look at the expected move, right? You can tell what's gonna happen, kind of, especially on earning. It'll tell you normal expected move, say 30, earnings might be 60. I'll add another 60, or even, you know, at least half or more. So instead of, say it's a $60 expected move, I'll do 90 or even 120. Just depends, because it's depending on the stock, right? So a strangle, you basically thinking, okay, I'm gonna do this. I'm gonna do Tesla 575 and 700. Okay. Now, right now, look at the. This one got pretty skewed to one end, which is the put side. Tesla is pretty skewed on the put side, because if you look at it, right, the same width with Tesla 575, and Tesla right now 615. That means that's about $40 move. It's $2. 615, you add 40, 655. It's only $1 something, right? So the skew is a little off. So you can tell that there's more put than calls. People are thinking the stock's gonna go down. Okay, so you can kind of look at the skew and figure that out. So a strangle is basically, you think of it as you are choking someone. This is their neck, you're choking, and you just want that within your hand as you're choking them, that they're gonna stay within this area, right? So you sell a 575, and you sell the other side a 675, for instance, just depending where you think it's gonna be, and you skew it. So Tesla pop, but it drop, it just stays within this range by earning or anything, or any weak expiration. As long as it stays within the range, you make money for both. Okay, so that's a strangle. Okay, so a strangle meaning you squeeze to strangle something, so to stay in the middle. Okay, a straddle means you sit on it, meaning you want it to be in the same spot. All right. Now a long strangle, there's not really you expecting the stock to go either below 675 or above above 675 or below 575. That's basically what you're doing, and your max loss is say here at 67 cents or at $2, right? So your max loss on this one is $2. Your max loss on this is 60 something cents. So again, depending on where you think it's gonna go by your expiration. Now again, keep in mind, theta, it's gonna keep on burning. Okay, so that's another strategy you can do. I don't recommend long straddles or long strangles, because it doesn't work unless it's long strangle work well if it's earnings, but it has to move correctly. That's pure and simple. It has to move. If it's in the middle, you're done for both. Okay, so any long IV crush, remember IV crush. Okay, so that is a few things. Now again, scalping, you can always scalp. So say you have an option 620 put and stock keep on going up, well, what you gonna do? You buy shares, right? 620 put, where's your delta? 55 delta, guys. That means you need to buy 55 shares to get yourself flat when it goes up. For every dollar Tesla move up, you get 55 cents. So Tesla, if Tesla at 620, let me erase this. If Tesla's at 620, it goes to say 630, that's $10 at 55 cents. At 55, 55 shares. So if you take that, do the math, right? So 55, we do 55 times $10. So 550 bucks, right? That's on one. And you own, say, one contract. Then there you go. You made back 550 bucks just for it moving to 630. You're not gonna lose as much here, right? So you already break even. You understand what I'm saying? So say if this turns to $10, you lost $4.50, but yet you gained $5.55. So now you're flat. Now, if you have 3 contracts, well, guess what? 55 shares times 3. That's just how you're gonna do. That's how you're gonna do to get yourself flat, right? But again, that's pretty simple there, as you can tell. That's just scalping, gamma scalping. You want to basically buy the shares to scalp for your position, your long position, right? Now if you short this, now again, Tesla's different, right? Tesla don't have shares to short, but if they do, just for instance, you sell a put at 620, now it's gonna go down below. You can do one of two way: buy a put, long put, or short shares, right? Now here's another example as to what I would do. I do a lot of ratio spread, as you guys are aware, and I love ratios because I look for expansion in option prices. Okay, so how do I look for expansion? Very simple. You know, a 600 put costs 630, 640, right? So I need to, and the ratio is equal to, if you can see it, it's a 1-2 ratio or 1-3 ratio. I don't do more than that, guys. Okay. So 1-3 or 1-2 or 1-3 ratio, it means you play one. Here's how it works. Okay, let me just explain that. So if you say you want to do 10 contract, that means that 10 in the front, 20 in the rear, right? That's a 1-2. It's still a 1-2 if you do fractions, right? And if you want to do 30 contract, guess what? 1-2 is 60, right? 1-3 is 90, right? Okay, so keep that in mind. So I do a 600, I buy, and this is 630. So now I'm gonna look for another premium that gives me around there. So here, 585. Now I'm looking at the chart and I see that Tesla can't go back to 590, right around here. So I'm gonna do that ratio spread, right? So 600 and 585. That's a $15 wide, guys. So you're gonna have one here and two here, two short. Okay. As Tesla drops below 600, this is gonna balloon, right? This also balloon. However, if it just stays right around and it drops slowly, this is gonna decay, and this is gonna balloon up just a slight bit as well. Okay, and it's gonna expand. But because you're $15 wide, this move faster, this delta increased faster, this delta here increased a little slower because it's further out. So you're gonna get an expansion and you make money and you can take profit, right? So that's another strategy. Now how do you, a lot of times this is what I do as far as it's concerned with the ratio spread. I would go ahead and take profit on this if it's a good stock, and I know that it's always going to come back, and I have 585. This one make great profit. Now keep in mind, it's a 1-2, right, ratio. That means that it's a debit spread. You bought here and you bought here and you sold here, but you add one extra. That's it, just one extra. So you can close the debit to make money, and you keep this as a sell put. You're gonna keep the premium. You're gonna keep the premium of this, and you get assigned 100 shares of 585. And then guess what? I would sell call against it next week. It's a great strategy. It's a sell put, but a skewed sell put So where you can make money if it drops on the 600. So you're gonna make profit on this 600. Pretty good. You're gonna get a sign on this for one share because you already have a debit spread, right? You can close this completely out and keep both of these. Remember, it's a 1-2 ratio, right? So you can keep both of this short and get a sign. Doesn't matter. You make money on the put side, and you get a sign on the short side. Sell call. I do this a lot. I haven't got one assigned yet because it works out well. I always look at charts and see where the stock's gonna drop. I try not to get a sign because your account value get diminished because now you own stock, right? So I don't want to own a lot of stock. And let's face it, when you do this too much and when a market crash and everything tanks, you're gonna get a lot of shares. So that's just something to think about. What else? Oh, and the ratio spread. Buy 1, sell 2. What can you do with ratio spread? Fantastic way of making money again, guys. Turn it into a butterfly. Right? How do you turn it into a butterfly? Look at this. You already got 2 here. You got 1 here. What do you just need? You just need 1 more over here. Because you already got 2 in the middle. Because as stock keep on dropping, you just add 1 down here to let it drop. Right? So you're $25. So now you need $5.60 here. So I gotta change that there. Right? So 600, 585, right? And 570, $15 Y. Boom, boom, boom. 2 for the body. Remember butterfly. Here's the wing. Right? Sorry, that's my butterfly. So I got 2, 585. And as stock's coming down, I changed it into butterfly, and it keep on going down. I'm gonna make this money, right? This is you're gonna lose on this end, the short, but you make here and here. And guess what you're gonna do? You can get this assigned, right? You can still get this assigned in the middle. Keep profit here and here. And sell calls. Rinse, repeat. Rinse, repeat. Eventually stock will go back up and boom, you're out. Remember, you got 2 here, right? So you get to keep all this as you get assigned. You get to keep $660. You got to make this money at 570. You get to make this money at 600. This is pretty good money actually, right? So you keep you made this, you make this, you keep this, and you get assigned. Then the following week, you sell at 600, or whatever the case may be. You own at 585. I would do 600 because you want more money, right? Because you want it to go back up. But if you don't want to hold the stock too long, you sell 585. Let it go back up to 585 and you're out. And you're not even negative anymore, right? Because you own it at 585. Stock dropped to 570. You were negative $15 a share. But now stock went back up to 585. Now you're at 0. You get to keep the credit of the 585 in the call side. It's a win-win-win-win every which way around. Now this is why I say do these for good name stocks. Have enough money for collateral. Don't be afraid to get assigned, guys. That's why I always do it on the put side, because you're gonna make money on the put side. And this is the best way to do it. Do good name stocks that you're not afraid to get assigned. Rinse, repeat, rinse, repeat. Stocks will eventually go back up. I mean, granted, that's not a guarantee, but history does show that stocks go back up, and they go back up in a good way, in a crazy way. I mean, we look at all the stocks has been doing this past year, right? So again, understand how to do things, how to scalp, how to get flat, how to gamma scalp, right? Just because a stock work against you does not mean that you're gonna lose money. It just means you gotta be patient, right? So if I sell a put here, a 600 put, and you can do this rinse repeat every single week, guys. You only need one stock and play it over and over and over, right? Apple, Microsoft, two of the best stocks that I know for a fact that you make money over and over again, because I'm not afraid it's gonna dip and never come back. Amazon, I'm sorry, but most of us don't have enough collateral to do Amazon, right? But if you do, I mean, think about it. Look at this. How much money are you gonna make every week? Right? So, hang on, I'm gonna put this on and you'll see. Okay, now I'm gonna pause it. Look at this. We're on June something. Let's do next week, right? June 25th. Look at this, guys. This is what Amazon is at. I'm saying, okay, let me sell this week at $3,300. I'm gonna make $2,100 each week. If Amazon drop, I'm gonna own it. Oh well. I need some money, of course. We all know you're gonna need $330,000 at $3,300, right? But if you have that collateral, if you have that money, every single week you're gonna make this amount of money, right? Now, what if you say no? I don't want. Let me do. If you have collateral, right? You do the ratio spread on Amazon as well, right? This is 21, right? And you need 2 for ratio if you sell one. So 2 is 40, so you need to do 40 or less. Look, so I would do this, $3,350, buy 1, sell 2. You still need the same amount of collateral. However, if Amazon dropped below 3,300, oh my God, this 3,350 just ballooned like crazy, right? Because it's a $50 wide. So now you close out a debit spread. Okay, you make money on the debit spread, right? Then you get assigned on one Amazon, and guess what happened next week? And then following week you sell, right? You now own at 3,300. What you gonna do? You're gonna sell at you want to get out, right? You don't want to hold it too much. You do it at again, you do 3,300. You get out. That's it. Very simple. Here we go. You're gonna get to keep this premium, guys. So even if Amazon dropped whatever the case may be, you sell at 3,300, so you can get out quick. And if it takes you a week, a day, a month, you're gonna get to make this money each week until it goes back up. It's not rocket science. This strategy has been proven over and over and over again for you to make money. The only way you're not going to make money is if you own the wrong stock. The stock that never goes back up. Right? So, you don't want to play those stocks. Or play it careful. You can still, but see, again, you can still own a stock and keep on selling call every single week and make an income. You hold that stock till it goes back up. Eventually, 10 year, 20 year down the road, it's gonna go back up, unless that stock go bankrupt. But other than that, if it get bought out, the stock price is gonna shoot up, and you're gonna get out. So again, it's not that hard to do these type of strategies. Gotta be patient. Don't cut loss just to cut loss. Think of a way to think of your exit strategy. Worst case scenario. If I own this stock, how much am I gonna make? And then what am I gonna do to sell the call and do this, do that? Guys, when you play options, you have a lot of options. And most options are there for you to make money. We all get scared, we all panic, and we all sell and cut loss and things like that. But if you're patient, if you're a patient trader, it will reward you. Okay, so I hope this helped you with some advanced understanding, advanced strategies. Sorry, it's a video, not a class. So I can't answer any of your questions. But again, hopefully this helps. And if it helps, let me know. It's gonna be a fantastic way for you guys to earn money. Okay, so ratio spread, I've went over a lot, which is ratio spread, iron fly, iron condor, butterfly, strangle, straddles. Understand what they are. Learn how to do it. My only advice is, if you're gonna exit or leg out anything, leg out the short side of the call. Okay? Play smart. It's okay to be assigned. Don't be afraid to get assigned, because remember, stock tend to go up or back up to that price. Okay? Eventually. Some stock might take longer than other, but history shows. Look, COVID dropped every stock now twice as much. And at the time when it dropped, we all thinking this is it. Stock never go back up. This is crazy. No, look. So we can never know. It just sometimes you gotta be more patient. And if you're not patient, cut loss. Cut loss quick. Okay, don't wait to cut loss, and then you lose a lot of money. But don't chase it either. Don't FOMO. I'm sorry. I know most of you guys, if you guys are apes, you guys hate me with that message, but it's true, guys. Don't chase something. Right? Look at the value of that stock. Do you think AMC is worth 100? Yeah, we all love for it to squeeze. God, I'm not in any shares of AMC. I don't have one. I'm just gonna play option. If it go up, I'm gonna play put when it go down. That's pure and simple. I'm not gonna pray and hope that this is gonna triple my money. No, that's not. You can end up holding forever. Right? What is AMC's worth today? It's worth $7, $10 max. Not at this price. So I'm sorry. that's why when you play this, and what I'm telling you now, it's okay, stock's gonna go back up. This is not the stock I'm talking about. So again, just play smart. Know what the company's worth. Know what's going on, not by hype. Because if that's the case, then if it goes down, cut loss, right? If it goes against you, cut loss. It's not worth it holding. Okay, so hopefully this helps you, and good luck trading tomorrow. All right.